Pat Dorsey is a believer in investing in long-term compounders, and especially he believes in companies with extremely durable moats. He goes into more depth in the book, The Little Book That Beats the Market, and I'm starting a series of videos where I'm exploring all the key concepts of moats in that, so I'll leave a link to it in the video description if you want to go check that out. I want to take a serious look, at least at a high level, at all of Pat Dorsey's portfolio companies because of his belief in companies with moats. So in this video, I want to explore Dorsey's second largest position in a company called Smartsheet. Now, as with a lot of his portfolio companies, this is a software as a service company. So it's going to be an asset light company. There are a few things that I still need to work through with the financials, but we'll dig into that once we go into Ticker and Morningstar to check out the financials. So in this video, I'll be going over Smartsheet at a high level. I'll go over their business profile, some of the top line financials, and try to get a feel for this company and maybe get some insight as to why Dorsey bought this company. I'm going to try to look at this company through Dorsey's own Moat framework. And who knows, this company might be a candidate for a potential clone from Dorsey. I'd love to hear your thoughts about Smartsheet, so please leave me a comment below on what you think about Smartsheet, if it has a moat, if it has a competitive advantage, or if it's just like any other product. I'm going to start with talking about this company within the context of his portfolio, and then we'll hop into some financials. Okay, let's hop over to Ticker, which in my opinion is the best place to track the portfolios for super investors like Pat Dorsey. So here we can see his entire portfolio, and his first position is Facebook, but Smartsheet is right under that, but it has almost the same percentage in his portfolio as his number one position. So that right away tells me something, that he has really high conviction in this company. In fact, in the last quarter, he added almost 18% to his position, which was already large. It was clearly already over 10%. So this is one of the reasons why I like Dorsey, is he's not afraid to swing for the fences, and getting close to 20% in one position is, for a manager of other people's money, is about as close to swinging for the fences as you can get. He actually owns about 2.5% of the entire company. So that's a pretty sizable chunk as well. It's not as big as his position in SEMrush, which is another SaaS company. I did a quick dive into SEMrush over here if you want to check that out, where he took 11.5% stake of that entire company. But Smartsheet is bigger than that company, so I think it's pretty reasonable. Okay, so here on the financials page for SEMrush, we can take a look at the chart. The chart dates back to about April of 2018. So the company has not been public that long, but I looked at the Wikipedia page and I believe that they were founded back in 2008. So as far as software companies go, this is no spring chicken. It was actually released back in 2006, according to the wiki page. So it's pretty old. The company has almost $9 billion market cap, so it's actually not as big as I was expecting. If we take a look at Dataroma, we can see that Dorsey initiated his position in Smartsheet back in the second quarter in 2020. So he's held this thing for not a huge amount of time, but it looks like maybe he snapped it up during the COVID pandemic or something like that. But basically we can scroll down here and get a little handle on what the company actually does. Smartsheet provides cloud-based platform for execution of work. It enables teams and organizations to plan, capture, manage, automate, and report on work. The company offers smart dashboards that provide real-time visibility into the status of the work to align individuals, managers, and executives. There's a smart portal. There are smart cards to organize, share, and act on workflows, smart grids, smart projects, smart calendars, smart forms. I think we get the picture. First of all, they like to use smart in the branding, which is kind of clever. But based off this description, it sounds like Smartsheet is a product that integrates and maybe even improves upon a bunch of different other companies' products that don't necessarily integrate with one another very well. All right, so we can head on over to their product website here. This is kind of interesting. Trusted by your favorite brands and over 90% of Fortune 100 companies. Does that mean that over 90% of Fortune 100 companies actually use this product? Or there was some sort of survey saying that they would potentially use a product like Smartsheet? I don't know, maybe we'll find out. But it does look like they have some pretty high-flying names: Apple, Procter & Gamble, NASA, Pfizer, Kaiser Permanente, and American Express. If we scroll down, we can see if we can get a little bit more information without going too deep into their product. The overview: it's a dynamic workspace that empowers teams to manage projects, automate workflows, and rapidly build new solutions using no-code tools that they love and backed by the security IT needs. One interesting thing, this is a no-code solution, and Dorsey also has invested in Wix, which is a no-code website builder, and SEMrush, which is also a no-code tool. So not only does he like software companies, but he likes software companies that other people don't actually have to code within. This is interesting. Integrations. The tools team love all in one place. Smartsheet integrates with your existing tech ecosystem. So it does seem like they have a robust offering of the tools within their specific product, but it also integrates with huge important players such as AWS, Google Drive, Google, Microsoft Teams, Microsoft. So even if your team uses Slack already, you can create probably a specific channel to manage your Smartsheet and get notifications directly into Slack about Smartsheet. That's a pretty nice feature. I'm gonna play a quick clip from this. I don't know if there's gonna be any sound for it or anything, but we can see that there's a dashboard with data visualization tools. It looks like we have a project tracker that can also transform into a traditional Jira board system where you can move cards from different categories of readiness. And then it also looks like it displays this in a pretty unique calendar format. And maybe we can scroll down and look at the Smartsheet capabilities. There's a whole chunk of different types of capabilities. Now, I'm not going to go through all of these, but this is going to be one of the first places I would come back to if I'm possibly thinking about digging into more about this company. I also want to take a quick look at the pricing page. This is for a team of 3 users, so that's $25 for the business, which is probably what most users would be using of a team size. For this, 200 plus users, yeah, they're not going to tell me, but I'm assuming that this enterprise level product is probably the one that they make the most money from. Now, that's speculation, of course, but that's just my hunch. Okay, we can dig into some financials now. Let's go over to the financials tab in Ticker. And we can first, I don't know why, but the first place I always like to go is look at the net debt number for this company. So they have a negative net debt number of negative $360 million. So that means that they have more cash and cash equivalents than total liabilities. So while in relation to the overall market cap, it's probably not that huge of a number, it's very clear that this business has enough cash to weather pretty much any storm, I would say. So there's no debt obligations. It's just like SEMrush. This company can live off its cash probably for quite some time. In other words, it has a really long runway of cash burn. We can come over to the income statement and take a look at the revenues. So revenues have been growing pretty quickly. We see 64% in 2017, 66%, and it's slowed down a little more recently, 60%, 52%, 42%. Now, those are obviously extremely high growth numbers. I would love that for any company that I was thinking about investing in. However, it is a little bit troubling to see that number is slowly declining year after year. In their last 12 months of revenue is nearing that $500 million mark, which is a number to be extremely proud of. However, compared to their almost $9 billion market cap, it makes the price to sales equation a little bit unkind. And with that, we're actually seeing the net losses for the business increase massively over the years. They were losing 15 million, then 50, then 54, then 96 million. Now they're 115, and now they're almost nearing $142 million losses in this past 12 months. That is a tough pill to swallow, I must say. So you start on the balance sheet and things look amazing. It's a software company, you're really excited. And then you see that it is just hemorrhaging in its earnings. Okay, so we can hop over to Morningstar. It's only fair that we take a look at Morningstar because Dorsey basically made their Moat rating system for companies. So I think we can use it a little bit to take a look at more of the financials for this company. These gross margin numbers are mind-boggling, to be honest. This company basically makes 80% gross margins. Only in the software business can you find margins this high. Okay, that might be hyperbole. Let me know what other businesses can achieve 80% gross margins besides software. But yeah, again, this extreme decline in their earnings year over year is really worrying. And I've got to wonder what's happening in their operating income that is making this so negative, because their margins on the top line don't seem to be decreasing very much. So, is it R&D? Is it sales and marketing expenses that they're spending this on? I don't know. All right, well, a few things that stick out immediately. The gross profit is continuing to increase, which is good. The change year over year is declining, but they're still excellent numbers. Now here is where we get to some of the big culprits with SG&A and R&D. So we have increased from about $50 million in SG&A expenses back in 2017 all the way up to $350 million this current year. It's a similar story with R&D expenses, about $20 million back in 2017, and now we're sitting at about $140 million. Now these are extremely shocking increases in these categories, and the question from me is, are these expenses necessary to keep the business afloat, or are these culprits of just trying to grow the business as quickly and as large as possible? So we'll want to figure out what is going into each of these categories. Is it necessary to keep the business continuing to grow? And what happens once those numbers and investments stop? Are they spending a lot of money to acquire customers that potentially might leave once they stop spending that money? That'll require further looking. This high working capital is probably a good thing in this situation. They have more current assets than current liabilities by a long shot. So they have enough money lying around where they can continue to invest. It's just a matter of, are they burning cash just to acquire customers? And will those customers have a long lifetime value? Based on free cash flow per share though, it does look like more recently they are trending down to being free cash flow positive. So if we contrast that with the earnings picture, that might be a silver lining that we can take away. And we can look a little bit at the insider activity. I'm seeing, based on this chart up here, quite a few sales. There has been one big acquisition, not on the open market, back in March. But it does look like these participants are exercising shares, probably that they were granted through stock options. We see some sales on the open market by the chairman back in August. You don't really love to see that, but then again, you never know why someone is selling, but you usually know why somebody is buying. So I'm not reading too much into that sale. However, I am seeing, as I'm going through, a lot more sales pretty frequently throughout the year. And these are all pretty recent, so that's a little bit concerning, but I don't think it makes me too worried at this point. So Smartsheet is sitting at about a 19 price to sales ratio, which really seems expensive to me, to be honest. These no earnings are just killing Smartsheet right now. I would want to ask management, why are these sales expenses so high? Why are the research and development expenses so high? When will they be pared down? And what effect are they going to have for the business for the long term? I'm hoping that Dorsey has an understanding of the answers to these questions, and well, he was confident enough to make an 18% bet on this company. So I'm sure there's something there. It's just at a high level, I don't really see it. So the first thing that comes to mind as to why Dorsey might have invested in this company is, of course, he probably thinks it has a moat. Now, what is that moat exactly? Well, I think that there's probably the key force of their moat is the switching costs related to this product. Now, imagine you have a team of 50 people that you're working with, and you all decide that the tools within Smartsheet are exactly what you need to help make your workflows more efficient and your collaborations more fruitful. Now, you spend weeks or months getting ramped up with this product. You have all of your information. You're basically running your business out of this product. Now, Imagine trying to stop using this product at that point. You don't have time. You're running your business, and if the product is good, you're going to continue to use this product. You are not going to integrate, even if you can get a cheaper price on another product. You do not want to risk switching to another product. Of course, that's all predicated on the idea that Smartsheet is actually a super useful and quality product that is going to only enhance your business. To attack this from an intangible assets perspective, maybe they do have some sort of technology patent. It's probably unlikely. So I'm guessing that the intangible assets, are just going to be the software that could potentially be replicated by another company. There's also likely no regulations that are protecting Smartsheet within their business. Cost advantages with Smartsheet, the pricing seems pretty standard for a SaaS company. You pay as the amount of users on the platform grow. I don't think they have very much cost advantage there. And then we can think about the network effect, where within the product, I think maybe this goes back more to the idea of the switching costs for Smartsheet, but the more and more people on the team that are using Smartsheet, the more invaluable the product becomes. But it doesn't really fit the traditional definition of a network effect. So I think we can basically lean pretty heavily on the fact that Smartsheet has a definite switching cost effect that is going to keep businesses using Smartsheet for a long time. And again, this is not the gospel truth. I'm sort of just thinking out loud here. I'd really love to hear from you in the comments below if you think switching costs is a big factor for Smartsheet, or maybe you know a lot more about this company. So please let me know down below. I decided to pull up the 10K for Smartsheet. This is their most recent one, 2020 fiscal year, I believe. I want to go down to the business section because I was looking through this and I found something pretty interesting. There's a description of the overall business here. This is sort of the best place to look for the description of the business, but it's this last paragraph that really got me interested. It says, our customers include over 90 companies in the Fortune 100 and over 80% of the companies in the Fortune 500. So that answers my question earlier, where on their website they boasted that it's trusted by over 90% of the Fortune 100 companies. They lay out a little bit of the annualized contract values. So they have from anywhere from $200 to over $2.5 million. That's 100 of the Fortune 500 companies. And then a quarter of all Fortune 500 companies had ACVs lower than $5,000 per year. And here's an interesting part. Our customers typically begin using our platform for a single initiative or project. Over time, as users realize the benefits of improved execution, adoption of our platform expands across an organization through the new use cases and teams. We deliver cloud-based software through a subscription model, self-serve subscription. We employ an efficient inside sales team that utilizes machine learning and lead scoring to respond to and convert other interested users within new and existing organizations. Okay, so maybe here is where we're seeing some of that R&D expense going. They're actually developing a machine learning algorithm to sort of nudge new and existing customers to buy Smartsheet subscriptions. They also have a targeted field sales team dedicated to expanding the presence within existing enterprise relationships. So yeah, a sales team, field sales, that's going to be pretty expensive. You got to pay for the salaries, all the transportation, everything like that. But I just can't believe that the numbers are increasing that much. Man, I could go on forever within this 10K though. This is actually really nice. Benefits of our platform: automation across the organization, real-time visibility, produces better content faster with content collaboration. This is a really in-depth look into the business operations. So if you do want to learn more about this would definitely be some good reading for this week. So overall, I would say that the switching costs goes back into that idea that maybe a company starts off with a small one project on their Smartsheet subscription, and then eventually realizes that it's a great product, integrates more of their business into it, and once their business is integrated, it becomes like this. It's pretty hard to come unstuck. Yeah, so as we see even more, they're constantly building features. They have this software platform, so not only is it more integrations with existing platforms and partners, but they are going to be improving and expanding their dashboard capabilities and just their tool set in general. So I can understand that gets expensive. Okay, yeah, I'm going to stop scrolling through this now. I could get carried away here, but definitely check this out if Smartsheet seems interesting to you. Okay, that's Smartsheet. I hope you enjoyed that little dive into the company. We covered some high-level profile information about the business. We looked into the product a little bit and explored the financials at a high level. I hope you enjoyed my attempt to try to put this in the framework of Pat Dorsey looking for moats. And if you're interested in learning more about moats, definitely check out his book, The Little Book That Builds Wealth. It's an outstanding book to understand moats better, and there's a link to that book in the video description. I've also included links to a few more books that I would highly recommend. If you like this video and want to learn more about another company in Pat Dorsey's portfolio, you may want to check out my video over here where I discuss his investment in SEMrush. Please let me know in the comments below if you enjoyed this format and if you're potentially interested in digging deeper into Smartsheet. Please like the video and subscribe to the channel if you want to stay up to date with more coverage on Pat Dorsey's portfolio companies. Thank you so much for watching this all the way to the end. I really appreciate your time, and I will see you in the next video.